Tom Lee, Fundstrat's head of research and chief investment officer, just went on CNBC and made a bold call. He believes this rally isn't over, even with war headlines, rising oil risks, and growing concerns around the market. In this video, I'm going to show you exactly what Tom Lee said in that interview, then break it all down and give you my honest take on whether this market can actually keep pushing higher. And after that, I'll walk you through 3 top AI stocks that could help you grow and protect your wealth in this environment. Let's hear what Tom Lee has to say.
Tom, good morning. We were just saying how this market has done a very good job of kind of shaking off or looking beyond the geopolitical situation over the last 4 or 5 weeks, really following the script, as you've pointed out, of other geopolitical conflicts in the past where, markets bottom well before things are fully resolved. But how do you view things right now after this nice winning streak in the market and the reliance on Mag 7 and semiconductors to get us here?
I think the risk reward for stocks is still pretty good. I know the war remains uncertain, but I think the war has also exposed the strength of the U.S. relative global position. Earnings estimates have actually gone up as earnings seasons progressed. The U.S. is a leader on AI, and that productivity lift is meaningful. I think it's really one of the drivers for not only GDP, but one of the reasons U.S. companies have been resilient. And I know there's a lot of investors still on the sidelines. So I think the war remains uncertain. And it certainly looks like it's going to be a longer war. But I do think stocks actually still have some tailwinds actually as we get through May and into July.
You mentioned the earnings estimates going up, undoubtedly the case, although there again, it's been pretty concentrated in the AI theme and in semiconductors and the other CapEx beneficiaries. So therefore, the market is somewhat narrowed out to that very dominant theme. I always keep an eye on the consumer discretionary equal weighted. It's 9% below its highs, right? So that's sort of where some of the economic frictions from the war can bite. So is that okay? Is that a good formula for how this market can continue toward your targets higher?
I think one of the reasons why it does feel concentrated is the AI story, which is a global productivity story, right? AI is essentially creating productive units that actually either help workers produce more or even replace workers in some countries. It's primarily taking place in just the U.S. and China. And so I'm not surprised in a way that we could see the U.S. companies actually disproportionately benefiting this because it's not really taking place in Europe. So I'd sort of expect that concentration. But, as far as like the effects later this year from higher oil, I think that's a negative consequence. And I think it raises questions about what the Fed could do. In fact, of course, we're getting a new Fed chair. That's why I think later this year, the markets could actually face a test around that. But for now, I think it's just an earnings tailwind story.
And actually, you like software, Tom. On Friday, you named it a top sector pick. Was there anything from earnings season, maybe from Microsoft's report, Atlassian? There are a number of software companies that have reported. Anything that you heard specifically that made you feel better about the sector?
Well, I think one of the things that's apparent to us around software is I know that investors are correctly thinking that they should question, the durability of these software models over time. But many of these companies are very well managed and companies will adapt. So it's become a sort of a derating story where investors are questioning future earnings. But now I think the risk reward is pretty favorable. So I think for the right companies and for the best businesses, this is a great risk reward.
Hey, Tom, just watching the headlines that we just got, stock futures jumping on this news that we got, again, from an Iranian news agency that 2 missiles struck a U.S. ship in the Gulf. What do you do with that? Obviously, we're still trying to react pretty quickly with this, but the futures sold off sharply on this. Dow futures down by 375 points. The S&P futures off by 40. How do you take these headlines?
I'm not surprised in the short term markets are going to react on a risk-off way. It makes a lot of sense because this adds to the fog of war. But if we take a sort of step back further, I think we're all settling in for the idea that this is going to be a longer war. I know it's going to have some effects on oil prices. And one of the things we've been writing about to our clients is really just puzzling over the fact that there's a price for oil today in the futures markets, but it doesn't seem to reflect the reality of there's acute shortages developing, and eventually price has to react. So for now, it's been pretty remarkable to me that the market's been able to see through that, and it's one of the reasons our base case is for markets to make it to the S&P to 7,300. But I do think at some point there could be a reckoning later this year, and I think part of it is the Fed being tested, a new Fed, and the second part is the market trying to reconcile the shortage of oil and the fact that futures prices haven't really reflected that shortage.
Yeah, I mean, I know you've been, Tom, on that idea that there might be a larger than normal, so to speak, correction at some point hitting later this year. Also interested to say you think that, some investors are still kind of off sides and underinvested after this rally we've gotten back to all-time highs, and that specifically retail investors seem as if they were kind of wrong-footed by this move, which goes in line with what I've been watching as well. It kind of got shaken out near the lows, and the news kept them out. So where does that stand?
I think we're still, when we look at investor positioning, 2026 is unusual because in past corrections, retail investors were the steady buyers, but this year it looked like they were selling into the lows. There's still a lot of cash on the sidelines. Sentiment's still really muted. And in our conversations and surveys with clients, we could still see that cautious positioning. So I do think that today's pullback is going to eventually be bought because, again, the underlying structure of the market is a good earnings visibility story with AI. And of course, demand for AI picks up if energy prices and other pressures are causing corporate margins to be under pressure. So I think investors are going to buy this dip.
Right from the start, the market is reacting to geopolitical tension around the Strait of Hormuz, and you see futures dropping fast on that headline. But what Tom Lee is really emphasizing is something we have seen play out over and over again in market history. Markets do not wait for certainty, they move ahead of resolution. He points out that despite weeks of geopolitical tension, stocks have continued to push higher, which tells you something important about underlying strength. And personally, I agree with that read. If markets were truly fragile right now, this level of uncertainty would have already cracked them. Instead, they are absorbing it. That is not weakness. That is underlying demand. What really stands out is his view on risk versus reward still being favorable. That might sound counterintuitive when headlines are filled with war risks and oil concerns, but his argument is rooted in fundamentals. Earnings estimates are actually rising. That is a key point. Markets follow earnings over time, not headlines. He also leans heavily into the idea that the United States is still dominating in AI, and that is not just a tech story, it is a productivity story. This is where things get interesting because he is essentially saying AI is acting like a multiplier on the economy. Companies are either making workers more productive or replacing certain functions altogether, which boosts margins and output. Now here is my take. I think this AI narrative is real, but I also think the market may be underestimating how uneven that benefit will be. Not every company wins in an AI-driven world. The leaders win big, and everyone else plays catch-up. That explains why so much of the market strength is concentrated. And that brings us to one of the biggest concerns raised in the interview, which is how narrow this rally has been. A lot of the gains are coming from mega-cap tech, semiconductors, and AI-related names. Meanwhile, other parts of the market, like consumer discretionary, are lagging behind. Tom Lee basically says this concentration is expected. In his view, AI adoption is not happening evenly across the globe. It is heavily centered in the US and China, and that naturally leads to US companies benefiting the most. I think that explanation makes sense structurally, but it also creates risk. When leadership is that narrow, the market becomes more vulnerable to shocks. If something disrupts those key sectors, the entire index feels it. He also touches on oil, and this is where the conversation shifts from bullish to cautious. He points out something very important that a lot of people are not talking about. Oil prices in futures markets are not fully reflecting potential shortages. In other words, the market might be underpricing a real supply issue. That is a big deal because energy feeds into everything. Higher oil prices can push inflation back up, and that puts pressure on central banks. And he even mentions that later this year, the Federal Reserve could face a real test, especially with new leadership coming in. And this is where I think investors need to stay grounded. It is easy to get caught up in the bullish momentum, especially when markets are hitting highs, but these underlying risks do not disappear. They just get delayed. Now, when he talks about software, I actually found that part of the interview very telling. He is bullish on the sector, not because everything is perfect, but because expectations have already been reset. Investors are questioning the durability of software business models, and that skepticism has pushed valuations down. What he is saying is that for high-quality companies, this creates opportunity. The risk is already priced in to some extent. And I agree with that framework. The best investments usually come when sentiment is uncertain but fundamentals are still intact. That is where you get favorable risk-reward setups. Another key moment in the interview is when markets react sharply to headlines about missile strikes. Futures drop quickly, and the immediate reaction is fear. But Tom Lee zooms out and says short-term reactions are normal. Markets will always go risk-off when uncertainty spikes. What matters is the bigger trend. And his base case is still that markets can push higher, even targeting something like 7,300 on the S&P 500. Now that is a bold call, especially given everything happening globally. But his reasoning comes back to the same core idea. Earnings strength, AI-driven productivity, and investor positioning. And that last point about positioning might be the most important one in the entire interview. He highlights that in 2026, something unusual is happening. Retail investors, who typically buy the dip, actually sold near the lows earlier this year. That means a lot of people missed the rally and are still sitting on cash. That creates what we call fuel for the market, because if sentiment shifts even slightly, that sidelined money can come rushing back in, pushing prices even higher. And I have seen this play out before. Markets tend to frustrate the majority. When people expect a drop, it rallies. When they expect a rally, it pulls back. Right now there is still a lot of skepticism, which ironically supports the bullish case. But Tom Lee does not ignore the risks. He clearly says there could be a larger than normal correction later this year, and he ties that to two main factors, the Federal Reserve being tested and the potential mismatch between oil supply realities and pricing. So what you are really getting from this interview is not blind optimism, it is conditional optimism. The near-term trend is supported, but the second half of the year could look very different. And if I had to summarize my own takeaway from everything he said, it would be this. The market right now is climbing on strong fundamentals, but it is doing so on a narrow base and with hidden risks building underneath. That is not a reason to panic, but it is definitely a reason to stay sharp and selective with investments. Because in this kind of environment, broad exposure might not be enough. You need to be in the right names, in the right sectors, and most importantly, you need to be aware of where the real drivers of growth are coming from. And that brings us perfectly into the next part of this conversation where we start breaking down exactly where those opportunities are and how to position around them. Now let's dive in and talk about three dominant AI-powered companies that are quietly positioning themselves to not only survive global uncertainty, but potentially come out even stronger. You are going to see how these businesses are building deep competitive advantages, how they are monetizing AI at scale, and why they could play a critical role in protecting and growing your wealth over the long term. The first stock is Meta Platforms, ticker symbol META. Meta is one of the most misunderstood companies in the market right now. Most people still think of it as just a social media company, but that view is outdated. What Meta has actually built is one of the most powerful digital ecosystems in the world, with platforms like Facebook, Instagram, and WhatsApp reaching billions of users daily. Before we even get into the numbers, you have to understand why this business matters. Meta controls attention. And in the digital economy, attention is everything. If you can capture and hold attention at scale, you can monetize it in multiple ways, whether that is advertising, commerce, or new AI-driven services. Now layer AI on top of that. Meta is aggressively investing in artificial intelligence, not just as a feature but as a core driver of its future growth. AI is being used to improve ad targeting, increase user engagement, and optimize content delivery across its platforms. This is not theoretical. This is already showing up in the company's performance. When AI improves ad targeting, businesses get better returns on their advertising spend. When that happens, they spend more. That directly increases Meta's revenue. It becomes a self-reinforcing cycle, and this is where Meta's moat becomes incredibly powerful. Unlike smaller companies trying to build AI models from scratch, Meta has access to massive amounts of real-world data generated by billions of users. That data is fuel for AI. It allows Meta to train models faster, improve them continuously, and deploy them at scale across its platforms. This creates a feedback loop that is very difficult for competitors to replicate. Now let's talk about the financial side, because this is where things get even more interesting. Meta has been showing strong revenue growth, driven largely by improvements in advertising performance. AI-driven recommendations have increased user engagement, which means more time spent on the platform, which translates directly into higher ad impressions. At the same time, the company has been focusing heavily on efficiency. After a period of aggressive spending, Meta has shifted toward cost discipline, improving margins and increasing profitability. So you have a company that is growing revenue while also becoming more efficient. That combination is extremely powerful for long-term investors. But there is another layer to this story that many people are overlooking. Meta is not just using AI to improve its existing business, it is also building entirely new opportunities around it. For example, AI-powered assistants, content creation tools, and business messaging solutions are all areas where Meta is investing heavily. These could open up new revenue streams over time, and then there is the long-term vision. Meta is positioning itself for a future where AI becomes deeply integrated into daily life. Whether that is through augmented reality, virtual environments, or intelligent assistants, the company is building the infrastructure to be a major player in that ecosystem. Now, I want to be clear here, this is not a risk-free investment. Meta still faces regulatory challenges, competition for user attention, and uncertainty around how some of its long-term bets will play out. But when you look at the core business, the fundamentals are strong. You have scale, you have data, you have improving efficiency, and you have a clear path to monetizing AI. And in times of global uncertainty, companies with strong cash flow and dominant market positions tend to hold up better. They have the resources to invest through downturns, adapt to changing conditions, and continue compounding value. That is why Meta is being positioned as a stock that could help shelter wealth. It is not about avoiding volatility completely. That is impossible. It is about owning businesses that can endure and grow despite that volatility. And in my view, Meta fits that description. Meta is positioning itself for a future where AI becomes deeply integrated into daily life. Whether that is through augmented reality, virtual environments, or intelligent assistants, the company is building the infrastructure to be a major player in that ecosystem. Now, I want to be clear here. This is not a risk-free investment. Meta still faces regulatory challenges, competition for user attention, and uncertainty around how some of its long-term bets will play out. But when you look at the core business, the fundamentals are strong. You have scale, you have data, you have improving efficiency, and you have a clear path to monetizing AI. And in times of global uncertainty, companies with strong cash flow and dominant market positions tend to hold up better. They have the resources to invest through downturns, adapt to changing conditions, and continue compounding value. That is why Meta is being positioned as a stock that could help shelter wealth. It is not about avoiding volatility completely. That is impossible. It is about owning businesses that can endure and grow despite that volatility. And in my view, Meta fits that description. Now let's move on to the second company, and this one sits at the very core of how information flows across the entire internet. The second stock is Alphabet, ticker symbol GOOGL. Alphabet is not just a search engine company, it is the backbone of how billions of people access information, make decisions, and navigate the digital world. Every time someone searches for something, watches a video, uses maps, or interacts with online content, there is a high probability that Alphabet is involved in that experience. Before we even talk about AI, think about the strength of that position. Search is one of the most intent-driven activities on the internet. When someone searches, they are not just browsing. They are looking for something specific. That intent is incredibly valuable, especially for advertisers. It is one of the reasons why Alphabet has been able to generate such massive and consistent revenue over time. Now bring AI into the picture. Alphabet is integrating AI directly into its search engine, and this is one of the most important shifts happening in the tech world right now. Instead of just showing links, search is evolving into a more intelligent system that can understand context, generate answers, and guide users more effectively. This changes everything, because if Alphabet can make search more useful and more efficient, it increases user satisfaction. And when users stay within the ecosystem longer, it creates more opportunities to monetize through advertising and other services. But it does not stop there. Alphabet also has one of the most advanced AI research divisions in the world, and it is deploying those capabilities across multiple business lines. From cloud computing to digital advertising to productivity tools, AI is being embedded everywhere. And this is where the scale advantage becomes critical. Alphabet has access to enormous data sets, massive computing power, and a global infrastructure that allows it to train and deploy AI models at a level that very few companies can match. This creates a strong competitive moat. Now let's talk about the financial side. Alphabet continues to generate strong revenue from its core advertising business, which remains highly profitable. At the same time, its cloud division is growing rapidly, driven in part by demand for AI-related services. Cloud is especially important because it represents a second major growth engine for the company. As more businesses adopt AI, they need computing power, storage, and infrastructure. Alphabet is well positioned to provide that. So you have a company with a dominant core business and a fast-growing secondary business, both benefiting from the same underlying trend, which is the rise of AI. That is a powerful setup. Another thing I want to highlight is resilience. In times of uncertainty, businesses that are deeply embedded in everyday life tend to hold up better. People may cut back on discretionary spending, but they do not stop searching for information. They do not stop using essential digital tools. That gives Alphabet a level of stability that many other companies do not have. Now let me give you my personal take here. I think Alphabet is one of the most strategically important companies in the AI race, but it also faces one of the biggest challenges. It has to innovate without disrupting its own core business too aggressively. If AI-generated answers reduce the number of clicks on ads, that could impact revenue in the short term. So the company has to find the right balance between improving the user experience and maintaining its monetization model. That is not easy, but if Alphabet gets this right, the upside is significant. It could redefine how people interact with information while still maintaining its leadership position. And based on what we are seeing so far, the company is moving in that direction. It is investing heavily, rolling out new AI features, and expanding its capabilities across multiple platforms. So when you look at Alphabet from a long-term perspective, you are looking at a company that is not just participating in the AI revolution, but actively shaping it. It has the infrastructure, the data, and the global reach to remain a dominant force for years to come. And in an environment where investors are looking for stability and growth, that combination is extremely valuable. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's get into the third company. And this one might surprise a lot of people because at first glance, it does not look like a traditional AI play. The third stock is Netflix, ticker NFLX. When most people think about Netflix, they think about streaming movies and TV shows. But what they do not always realize is that Netflix is one of the most advanced data and recommendation platforms in the world, and that is exactly where AI comes into play. Before we talk about growth or numbers, let's start with why this business matters. Netflix controls a massive amount of user attention across the globe. Millions of people log in every single day, not just to watch content, but to discover what to watch next. That discovery process is where Netflix has built a powerful advantage. Its recommendation engine is driven by AI, and it is constantly learning from user behavior. What you watch, how long you watch, when you pause, what you skip, what you rewatch. All of that data feeds into an algorithm that becomes better over time. This is incredibly important because in the streaming world, content alone is not enough. Every platform has content. What keeps users engaged is how well the platform can surface the right content at the right time. And Netflix does this exceptionally well. Now here is where things get even more interesting. AI is not just improving recommendations, it is also influencing how Netflix creates content. By analyzing viewing patterns and audience preferences, Netflix can make more informed decisions about what shows and movies to produce. That reduces risk. Instead of guessing what audiences might like, Netflix can use data to guide its strategy. That gives it a major advantage over traditional studios that rely more heavily on intuition and less on data. Now let's talk about the financial side. Netflix has continued to grow its subscriber base globally, and it has also been improving its monetization strategy. The introduction of ad-supported tiers has opened up a new revenue stream, allowing the company to reach more price-sensitive users while still generating income through advertising. This is a big shift. For a long time, Netflix relied almost entirely on subscription revenue. Now it has a hybrid model, which makes the business more flexible and potentially more resilient in different economic environments. And here is where the sheltering wealth angle comes in. In times of uncertainty, people tend to cut back on large expenses, but they still look for affordable entertainment. A streaming subscription is relatively low cost compared to other forms of entertainment, which makes it more resilient during economic slowdowns. That gives Netflix a defensive characteristic that many investors overlook. Now let me give you my personal take on this. I think Netflix is one of the most underappreciated AI plays in the market. It is not building large language models like some of the other companies, but it is using AI in a very practical and highly effective way. It is using AI to improve user experience, increase engagement, and optimize content decisions. And all of that directly impacts its bottom line. At the same time, Netflix has already gone through its major growth transition. It is no longer just a high-growth subscriber story. It is now focused on profitability, efficiency, and monetization. That shift is important, because it means the company is becoming more disciplined, which is exactly what you want to see if you are looking for a stock that can help protect and grow wealth over time. Now, of course, there are risks. Competition in streaming is intense, content costs are high, and maintaining subscriber growth at scale is not easy. But when you look at the overall business, Netflix has a strong brand, a global presence, and a data advantage that continues to improve its platform. That combination gives it staying power. And in a market where investors are looking for companies that can navigate uncertainty while still growing, Netflix stands out as a unique player. Now, when you step back and look at all three of these companies together, something becomes very clear. They all operate at massive scale, they all have deep data advantages, and they are all embedding AI into their core business in ways that drive real financial results. Meta is monetizing attention through AI-driven advertising. Alphabet is redefining how information is accessed and monetized. Netflix is optimizing engagement and content through intelligent data systems. These are not speculative trends, these are already happening, and that is why these companies are being positioned as stocks that could help shelter your wealth, especially in a world filled with uncertainty, geopolitical risks, and shifting economic conditions. Now here's the question I want to ask you. Which of these companies do you believe has the strongest long-term advantage when it comes to AI, and why? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.